Good morning and welcome to another edition of Main Management's Weekly Market Note. This is through the week ended August 6th, 2025. I'm Alex Varner, our head of research here, alongside
James Maxwell, VP of Research.
Let's get into the week that was. On the performance data for the trailing week, things kind of ended on a sad note, mostly down across the board. Utilities was the only sector to post a gain. Materials got hammered a bit, down 6.1 just in that week alone. On the broader index side, you had Euro stocks and small caps leading to the downside, while fixed income and commodities were up. Kind of interesting to see materials down while commodities were up.
Yeah.
Those are kind of lumped in together, but clearly some different dynamics going on there. So yeah, I mean, things are still mostly positive for the year. But for the sectors, again, you have energy, consumer discretion, healthcare still in the red, while the rest of them are up on the year. So we look at the recession dashboard. We had a couple changes in July. Employment switched to blue from red, and then PMIs switched from blue to green. Again, kind of just middle of the road for the vast majority of these. We'll get into that employment number in a bit, but kind of a little bit worse than expected, but not super, I don't know, from what we've seen, kind of not ringing alarm bells. But as we move in, one of the bigger things of the week was the Federal Open Market Committee meeting this week, and they left rates unchanged as expected. However, for the first time since 1993, there were two dissents from members of the Board of Governors, which were Bowman and Waller. They wanted a 25 basis point cut, and this was on Wednesday, I think, that this came out. So before the employment data. They were at that point, they were kind of saying, all right, the employment numbers are steady as she goes, inflation steady as she goes, and they didn't see the bad employment report yet, I guess.
There was a funny headline from JP Morgan Research that was 2 job applications attached to the FOMC meeting from Waller and Bowman. Clearly there's some incentive there. I know Waller is one of the people being looked at for potential Fed chair after
Powell replacement.
Powell, ends his term in 2026. So clearly there's some incentive there to show Trump, who will be picking that chair, hey, I'm willing to. I think we should cut rates. I know you think we should cut rates. And they probably believe it as well, but there is that incentive.
There's some kind of posturing and cross pollination, I guess. From politicking. That's what I'm looking for. And then after the payrolls report, the odds on the Fed funds futures shifted dramatically. We're heading into them. They were expecting 1 to 2 cuts. Now we're at 2 to 3. So we've got between 2 and 3 cuts. We've got an 85% chance of 2 to 3 cuts. Whereas before, 3 cut odds were at under 9%, and they jumped to 44 just on that non-farm payrolls report. So again, the Fed has clearly maintained that they are data dependent. They will wait and see. And, as we've said this whole time, kind of one report doesn't make a trend. But again, you'd hope that maybe we'll see some firming up here. And we kind of touch on a few other things coming up around those numbers. So getting into the non-farm payrolls figure, non-farm payrolls were up 73,000 in July. That missed forecasts for 100, 110K. That's kind of the pace of kind of labor market stability. I think they've said around 75 or 80K per month is kind of standard job growth. The bigger concern within this thing was that May and June were revised down by a combined 258,000 jobs, revised lower. So those ended up at 14 and 19, I think, for those 2 monthly figures. So if you'd known that they were that bad, then people would have been happy with this report because it showed an acceleration, but you got this massive downward revision. And so it kind of dulls the more positive. It totally overshadows what happened in the rest of the report, I think.
It's funny, on revisions, typically they don't really have a market consequence because there's several months in the past, and the market is this forward-looking entity. But in this case, if you look at the past few months, employment's been very, very strong relative to what you kind of saw in GDP figures or just broader growth metrics. You're kind of running at this 1.5% growth pace, and the jobs reports that we were getting last month and the month before were kind of this outsized growth, and to a lot of people, it was
kind of inconsistent with.
It was inconsistent with everything else. So I think these revisions have really brought back employment back to what it kind of should have been, or to be more consistent with the rest of the economy. So there's not really that remaining question mark, but obviously it is a kind of fearful thing when there's 200,000+ jobs that thought were to be thought were to be added, and those got subsequently revised,
kind of vaporized.
So I can see why the reaction
was negative.
Today you're kind of giving some of that back on the upside, but it's kind of a lot of this data revision type of stuff can be funky. It usually doesn't have a market consequence, but it does show that labor market has been trending weaker than
there are market reactions, but not kind of longer. I think the reaction was clear on Friday, but then they kind of look through it over the weekend, catch their breath, and at least as of now that we're recording this, we're up percent and a half on the day. Kind of looking through at the other numbers on the table on the right here. The unemployment rate ticked up to 4.2. That was as expected. Labor force shrunk by 38K. Participation rate ticked down to 62.2. The household employment figure fell by 260K. Number of unemployed were up. Earnings were solid, up 33 bips month over month, and accelerated to 3.9% year over year. So that's still outpacing inflation. So people are getting real wages, which is a good thing. On the labor force and participation side, so both the overall participation rate and that for the prime working age cohort of people aged 25 to 54 years old declined. The 25 to 54-year-old rate is now at 83.4, and the overall rate is at 62.2. The concern is that overall rate is at 62.2, and it's its lowest in 2.5 years since November of 2022. And then also kind of concerning there is the number of people not in the labor force has jumped by 1.4 million in the last 3 months. An issue here is that people, if they need to be actively looking for work in order to be counted as unemployed. So when they stop looking for work, they fall out of the employment picture and out of the denominator. There was a chart out there that I saw that said that the unemployment rate would be closer to 4.9 if they counted those who have left the labor force. Because you could be not in the labor force and you consider yourself unemployed. But if you're not looking for work, then the government doesn't consider you unemployed. You were just kind of in purgatory, and you're in statistical purgatory in that you're not being included in either equation. So
it's one of those quirks with the U3 unemployment is it's looking at people that are looking for work being in the labor force.
Engaged in the labor force.
So if you're retired, if you're sitting on, your front porch just retired, you're not considered part of that unemployed statistic because you're not looking for a job. So one of the things that we were talking about before this is, especially on the immigration side, with the lack of immigration, illegal and legal immigration, the past 6 months since Trump had come into office, there's a lack of kind of inflows on the employment side of things, or in the labor force side of things, where yes, you might have people regularly retiring, exiting the labor force, that stuff kind of happens as normal, and typically you have inflows coming in from immigration, or maybe people entering from graduating college, or whatever, however they're entering the labor force. It seems like, at least from looking at the data, some of the weakness is from a slowdown in those inflows into the labor force. Outflows from the labor force are relatively consistent.
That hasn't been huge.
So it's probably both sides, but it is something to watch and an effect we're seeing from the reduced immigration.
Moving forward onto the core PCE. So this is the Fed's preferred inflation measure and the other side of their dual mandate. We touched on Fed and we touched on unemployment, so we touch on PCE now. But that was basically in line with forecasts, up 0.26% month over month. Year over year is basically up to 2.8, which is slightly above forecasts that were for a 2.7. And then it was good to see consumer spending rebound. It accelerated at plus 0.34 month over month, a slight miss, but you saw May's decline, and that kind of raised some flags. People were like, uh-oh, the consumer's stopping spending. But I think you just had a pull forward effect in March, April, that people were afraid of tariffs. They spent not all their money, but they spent more money then. And then as a result, you just had a weakening in demand. So seeing this rebound is a good thing to kind of solid line.
They bought things they didn't immediately need. And then didn't need to buy those next month.
Exactly. And on the income and savings side, kind of income's rebounded. Last month was a kind of a statistical Social Security calculation issue that caused incomes to dip, but those rebounded. And they're up 4.7 on easier comps, and the savings rate was basically unchanged. You remember a couple weeks ago, we touched on the consumer cash pile that is at record highs. And this week we actually get household debt, so we'll see a little bit more there. But again, people kind of just chugging along.
Yep.
Pretty standard on the savings rate side, but still contributing, which is a good thing. On the JOLTS, so this is June, so this is basically a month delayed. And when we got this report on Tuesday, I think it came out, it was basically steady as she goes. Labor market is still chugging along. It's kind of hard to believe we're still 5 years on, recovering from pandemic distortions. But openings tick down, hires tick down, quits tick down, layoffs tick down. So kind of things down across the board, not in any huge measure, nothing to really kind of either call home about or, call the paramedics to help revive. But this is going to be watched next week, next month, to see if there are considerable revisions in this, like we saw in this week's payrolls report. So that'll be interesting to see as we come out there. And then as we were talking about continued moderation, where the ratio of openings to unemployed persons was basically unchanged at 1.06. So that is slightly more than one opening per unemployed person. If you remember, we were up at like 2-3 openings per person. This is still continuing to moderate. And on the right, there's the Conference Board labor market differential, which is those who define jobs plentiful, netted against jobs hard to get. And that continues to kind of, move back towards its median. This thing is clearly hugely cyclical. You can see it just goes up and down and up and down.
Close. It tracks the unemployment rate very closely as well. That's something that we've looked at. It has a very, very high correlation to that. So it's another kind of alternative that you can use. And I think the last I looked at this, it implied kind of, given where this index is, or where the sentiment it is of people thinking that jobs are hard to find, you'd expect a higher unemployment rate, kind of what we were just talking about. Some of this data seems better or worse, or there's a lot of distortions, or a lot of kind of things don't add up. So just something else to watch.
Yeah, and again, people who could identifying jobs hard to find or jobs hard to get, they can give up, stop looking, and then they fall out of the equation, as we mentioned. So there's a lot of different ways that this can be kind of affected on the margins by the BLS statistics and definitions for groups.
Yeah, it does show, you can't just look at one indicator. You can't just look at unemployment and say labor market's fine. Clearly there's stuff going on underneath the surface.
On the payroll side, on ADP, so this is yet another employment figure. This is private payrolls. But those surprised to the upside. So again, this is always taken with a grain of salt relative to BLS. But generally, when the report is good and stronger than they wanted, people like it and they'll pay attention to it. And when it's weaker, then they just pretend like it didn't happen. So this came in better than expected. They kind of, this made some people be a little bit more optimistic for the NFP's report that ended up not being great. But again, here you've got medium and large firms continuing to add. So total 104K ADP payrolls. The concern here is that medium and large firms added 46K each, of the vast majority, while small firms added just 12,000 jobs. That was after 2 down months. So it's good to see that move back into positive territory. But small firms are like 44% of payrolls. And that's really what drives, between small and medium, they're at 85% of employment. So you want to see those small firms are the single biggest employer of people. So seeing the weakness there is not great. It is nice that there's others are picking it up. And it is interesting that the large firms, 500 plus, are at their highest share of the employment picture ever. They're like 18%. So that has been moving 18%, 12%, I don't know, under 20, but they've been moving up steadily, kind of picking up steam as the small and medium firms have faltered, so to speak. But small firms are ticked up on a year-over-year basis. They're still up hardly 0.5%. That's basically the smallest gain since March of 21, when you were coming out of the pandemic distortion. So not great on the small business side, but again, 104 was good relative to what people hope for. Finally, we got the Q2 GDP figure. The first estimate came in at 3%, which is solidly above forecast for a 2.4 reading. Again, this is Q2, so we're already past it. We're out of it. This ended in June. Similar to those revisions that James mentioned earlier, where this doesn't really move markets because we've already lived through it.
you can kind of guess what the growth is going to be by looking at everything else the more real time.
Yeah. And the big reason for this switch was, after last quarter's 0.5% decline, you got a rebound to 3 on basically those net trade figures. Net imports. Imports went from plus 38 to minus 30. And so net exports went from negative to positive to additive on the GDP. Real private domestic investment was the biggest weight. That fell 15.6% quarter over quarter and dragged on it by 3%. But you saw consumer spending contributed nearly 1%, which is good after the weak Q1. As we move into kind of some data points here, the final sales, it was good to see those, and those are the value of goods and services sold to end users, excluding intermediate goods that are used to produce other goods. So this is really kind of end user demand, like you and me going to the store and buying. That's a final sale. And so it's good to see that rebound. That was the biggest increase since Q2 of 2021. And then you saw core PCE decelerate a bit. It came in slightly above forecast, but nice to see that pulled down from the Q1 reading. So again, this quarterly GDP doesn't show much on the inflation side either.
One other thing on the GDP report that I thought was very interesting, I saw a chart out there, or a stat out there, that was looking at kind of this CapEx that you see from a lot of these hyperscalers, Microsoft, Amazon, Meta, etc. This kind of AI build out. If you look at the underlying components of GDP, they define it as information processing equipment plus software. The growth rate for those two pieces actually contributed more to the headline GDP than consumer spending in the first 2 quarters of this year. So it shows how much actually impact that this AI build out has on GDP and on the economy. It's really being supported by the hundreds of billions of dollars that are being spent in building out these data centers and manufacturing.
Yeah, this is some staggering numbers on the dollar basis. So to sum things up, as we mentioned earlier, July non-farm payrolls missed with big downward revisions. The core PCE basically came in line. So the inflation side of the Fed mandate is pretty solid. The employment side, labor market is a little tenuous now. You saw the result was FOMC meeting where 2 dissents, or not the result, this is kind of ahead of the NFPs, but 2 dissents for wanting 25 cuts. Now markets are pressing in far, 2 to 3 cuts versus 1 to 2. June JOLTS, which is delayed, but that showed ongoing moderation. So we'll see if July sees any sort of weakness in correlation with the July non-farm payrolls. On the other hand, July ADP payrolls came in better. So you're seeing a lot of mixed messages, I guess, kind of in the data.
It was funny on Wednesday when you had, I think it was the GDP and the FOMC meeting. It was kind of like, oh, the economy's doing great. Like, if anything, it's doing too well to cut anytime soon. And then a couple of days later, it was the jobs report, and it was like, actually, no, the economy's falling apart.
And it is worth pointing out that Trump did go out and fire the commissioner of the Bureau of Labor Statistics in a classic shoot the messenger case. You can think about that what you will, but it certainly is an interesting choice given the optics of it.
Yeah, there's a lot to criticize on the data side of things, but I think the government data that we are given is very strong and informative. It can be revised. It can have errors. Like that is part of what it involves trying to measure.
But as far as relative to other governments, we're, I think, head and shoulders above almost every other one as far as transparency, frequency, quality, like that, like the data that the government puts out, whether it be BLS or BEA, DI, or was it the EIA, the energy? Those are it's really, really good data. So I think to kind of point fingers at that is kind of a misstep, so to speak. And then to bring it back real quick, we got, as we mentioned, Q2 GDP beat forecasts 3 versus 2.4. Again, that's on net trade balance kind of shifting. This week we get the trade balance tomorrow, so that'll be interesting to see on the goods and services, imports, exports. Get service and composite PMIs. We also get household debt and Q2 productivity. So that's kind of the week coming up. And we'd like to thank you again for joining us for another weekly market note here with Main Management.
Great. Thank you.
Thank you.